we are going to be discussing today how to save money on your mortgage. Anybody can do this that is buying a house. If you're refinancing a mortgage, whatever it is, you can do this if you own the house. It's awesome. It's going to save you, most of the time when we do these analysis, over $100,000 in savings, especially if you do it the correct way. Can't wait to dive into it. Before we do, I'm Joseph Ranke. Thanks again for joining us. Be sure to subscribe to the channel, hit the notification button, share this with your friends. It helps them, it helps you get notified when we put out new videos. And of course, it helps us too to grow and get the word out on different tricks like this. So make sure you hit the subscribe button. What are we going to be talking about today? How do we save money on a mortgage? How do I save money buying a house? All this type of stuff. It's this little thing called mortgage points. Okay, now, this does not help you if, I'll tell you right off the bat, if you're trying to do something to save money in the short run, you're trying to flip a house, you're doing a rental property, whatever it is. This is if you're buying a primary house. Again, mortgage points. I'm going to talk to you about what they are. I'm going to show you how the industry is flawed in the way they use them, if they use them. And I'm going to show you how you can actually take advantage of it and say, yes, this is exactly what I should be doing. Okay. First and foremost, what is a mortgage point? Okay. A mortgage point is when you're getting into the loan, it gives you the ability to buy down the interest rate. Basically, it's like prepaid interest. And so what ends up happening, let's just say you have like a $400,000 loan and the lender says you can buy the rate down for 1 point. What that means is 1% of the loan balance. If you pay that to the lender, they'll give you a lower interest rate. So let's just say you got a $400,000 house. That means, or a $400,000 mortgage, I should say. 1 point means if you paid them $4,000, you'd be able to get a lower interest rate. They might come back and say something like at 1.5 points or 150 basis points, another way of saying it. I'll touch on that in a minute. But 1.5 points, 1.5 points, you can buy down the rate. That would be, in that same example, $6,000 you'd have to pay. And oh, by the way, I'm going to show you at the end of this video how you can get those points without having to pay them also. So you can get a lower interest rate and you don't have to pay them up front. So you're going to see that. Okay. Now, that's the premises of what a point is, how they work, how you have to pay them up front. I'm going to show you calculations and how you can figure all this stuff out, and what you should you be paying points, how much you should be paying, all that. But first I want to take a step back. Why do most people not know about this? Okay, not know about this quote unquote secret. Okay. First of all, don't feel bad that you don't know about it, because most lenders and most mortgage brokers and most real estate agents that I talk to don't know about it. Okay, so that's the crazy part, is like a lot of them don't know. Okay. Second of all, like financial planners and experts and all these other financial experts, they don't know about them, like, because they don't deal with mortgages and that type of stuff. Okay, so oftentimes these things go overlooked. Now, the lenders and the brokers and the real estate agents that do know about them oftentimes use them wrong or use the wrong analysis. So I'm actually going to show you that and how they do that, so you know what the analysis is, and I'm going to show you the one that you should be doing to make sure that you're doing this stuff correctly. So let's jump right into those calculations, okay? Those of you that aren't aware, haven't seen our other videos, this is our fitbucks.com platform. If you want access to this tool, it's free. You just build your profile at fitbucks.com. You get to the dashboard, you come over here to tools, hit home ownership. We're going to be using this specific one right here, mortgage point optimization, okay? So if you wanted to just actually follow along in this video, you could pause it, go build your profile, go on to here, and you can actually follow along while we're doing this, all right? So let's jump into it. Mortgage point optimization. If I come over here and I just say, let's get started, I'm going to go back to that same example I used earlier. $400,000 mortgage is what I'm looking about at getting. I hit next, and this is where I come in. I hit my, put in my own, my offers. So the first thing I want to do, I also want to compare this to no points. Okay, so right now, let's just say interest rates are about 7%. So I might get an offer at 6.25%. at 1 basis point. Now, I mentioned to you earlier, the way these things are phrased and the way they're written are different everywhere, okay? If you hear somebody say 1 point, that's actually 100 basis points. It's the same thing. So in our tool, we have you put in the basis points, okay? And if you need an explanation of that when you're going through this on your own, there's an explanation right here of how to do that, okay? But this is 1 point on this. And let's just say the other offer was you get a 6% at 2 points, okay? Now, the first analysis that I'm going to show you is what most lenders, the few, like the low percentage that actually know about these, this is what most of them are going to show you, okay? It's not that it's 100% wrong. It's just got flaws in it. I'm going to tell you what those flaws are, but let me show you what it is first, because I want to go through this so that way you understand how this stuff works and how the calculations work for the one that you should be using, okay? So I'm going to hit next, and I go into this thing called the break-even method, okay? So you can see here, it says points paid in dollars. So this is like that upfront fee that I told you. How do you have to pay for it? Again, stay to the end of the video. I'm going to show you how you don't have to pay for these. But this is what you got to pay for upfront. So $4,000, okay? If I paid no points and I had a higher interest rate loan, my monthly mortgage payment would be about $2,661. But because I have a lower interest rate, my monthly payment with the first point offer is $2,463, okay? So the difference in my monthly payment is $198. So the break even, what that is, it says, well, how much are you saving in a monthly payment every month? And then compared to how much you had to pay for it. So you just take what you paid for it divided by what you're saving. That's 1.7 years. So by paying 1 point, what this is saying is, if I plan on holding my loan, my mortgage, for more than 1.7 years, it makes sense to pay this up front, this $4,000, because every month after 1.7 years, I'm saving money. Okay, I'm saving a lot. Now on this one, this is the second point offer, where I pay $8,000, drop my interest rate a little bit more. The break even is 2.5 years. Okay, which is still good. Typically, when a lender does this and they're using this type of analysis, they'll say if you can break even in 3 to 5 years, then you would want to pay those points. Anything above and beyond that, don't pay. Okay, that's what they would say. Now, here's the flaw in that, okay? This only works if, for example, in this first point offer, if I was going to take this money, this $198, and I was just going to blow it. Okay, so I've heard lenders say that, like, you should pay points because it's the monthly payment that you can afford. Look, I'll just be flat out honest with you. $198 extra, if you can't afford an extra $198 a month, you shouldn't be buying the house. You're taking on too much risk. Okay, that's number one. So that's not a good reason. So unless you're just blowing this money, this type of analysis is flawed because it doesn't look at what you do with that money. And so that's what I'm going to show you next, how to actually do this analysis where you say, look, not only is my monthly payment smaller, but I'm actually going to do something to generate wealth with this money. Now there's two things you can do with it. You could say, I'm going to use it to pay off my loan even faster, and then once my loan is gone, I'm going to then reinvest the money. Or I'm just going to make this payment now. Maybe you have a really good interest rate, right? And you think, hey, I'm going to take this money now, and instead of using it to pay off my debt, I'm going to invest it now. So those are the two scenarios we need to look at. We make it easy for you. All you have to do is click this button right here, switch this over to investment methods, and you can see here, I'm going to focus on this first point offer right here, okay? Because this is the 1 point where it's just simply I'm paying 1 point, $4,000, so on and so forth, okay? What this one does, just to refresh your memory, is it's saying my monthly payment is $198 less than if I did not pay any points. I'm going to use that money to pay off my loan as aggressively as possible. And then once my loan is gone, I'm going to turn around and I'm going to reinvest that money. So what happens? How fast do I pay off my loan? You'll see here that my loan is paid off in 24.5 years. So instead of being a 30-year loan, it's 24.5 years. So now what happens? My loan's paid off. So what happens if I don't have to make this monthly payment of $2,661? I can start investing that now. So here, after 30 years, this is what happens. This is why this stuff is so powerful. Okay? Most people will not pay points. So after 30 years, they have their house. Let's just say the house is worth $600,000 at that point. But you're smarter than that. You paid points. Not only is your house paid off, but you have an additional $185,000. That's why I get so excited about this stuff, because financial services, from investing, mortgages, student loans, car loans, all these different things, if you know these little tricks, there's money like this to be made everywhere. Everywhere. Okay? But that's the first example. What happens if I paid off my debt first and then I turned around and reinvested? So like I said, there's two scenarios. What happens, the second one is, well, what happens if instead of paying off my debt fast, what happens if I just invested it from day one instead of waiting? Well, we just scroll down and here's that. So you see, you make the payment for 30 years, this lower payment, but I invest the difference from day one. I end up with about $147,000. Okay, so still not bad. Okay, now this is where you have to make your decision. First decision you have to make from a pure numbers standpoint. Because of where mortgage interest rates are at and whatnot, it would make sense for me to pay off my loan, use that extra money to pay off my loans, and have $185,000 because $185,000 is more than $147,000. Okay? There's also a qualitative side of this. Some people are like, look, I'd rather have money in the bank, investing in the stock market, whatever it is. Just I'd rather have the asset instead of paying off debt. I can always sell my house if I need to, whatever it is. So some people would rather say, look, I'd rather just invest this because I'd rather have the money. That's completely up to you. But now you can make an actual decision of saying, hey, what are the numbers? Because sometimes you can do this. And depending on what the point offers are, depending on what the mortgage rates are, depending on what the home values are, where the real estate or what you're going to invest it in, all that type of stuff, it can be drastically different. I've done these numbers where it's like 150, 200 grand difference. Okay. So it just depends on the environment, but that's paying points. That's how you need to analyze it. Now, I mentioned earlier, you want to stay to the end of this video because these points, these mortgage points, and this is how you save money on a mortgage. You have to pay them up front, okay? And it's considered prepaid interest, so you can actually write it off over time also on your tax return, okay? But I told you there's a trick that you might not have to pay them, okay? So if you are buying a house, you can do what's called a seller concession. And you can tell the seller, look, I'll pay you XYZ price. So maybe you were going to offer him $400,000. But instead you say, hey, look, for a purchase price, I'll buy this house for you for $410,000. But I want a $10,000 seller commission or concession. Seller concession. Okay, what that means is they are going to give you the money to buy the points. And they get the money from the mortgage company. Now, some of you might be saying, well, wait, that means that I have a higher mortgage because I was going to only borrow $400,000, but now I got to borrow $410,000. Yes, but the interest rate's so much lower, net, you're still going to net out about $160,000 more in the long run. Do it. Okay, it's a major trick. Now, if you need lenders in the comments, I'll put two lenders in the description of the video that know exactly how to do that. Like you're going to be buying a house and you want concessions. I'm going to put two of our lending partners in there from FitBuck, so that way you guys have access to that. But again, I'm going to summarize how to save money on a mortgage. The biggest way to do it is what I was just saying. Okay, getting points. Let it be on a purchase or on a refinance. Even if you're refinancing, do the same type of analysis. Now, one thing I will touch on though, some lenders, you might ask them for it. They might not know what you're talking about, or they might give you the wrong ones. That's why it's important to work with guys that know what they are doing. Okay? So, again, these points, when we run these analyses, you can use the break-even one method, but it's got its flaws. Okay? This method, financial planning method is what we call it. Where you say either, hey, I'm going to take that extra money and I'm going to pay down my debt faster and then reinvest once my debt's gone, or I'm going to pay off the debt slow and I'm going to invest the money today. You can compare them, and then you're ready to drop this into your financial plan and say, I know I'm going to buy a house. I know I'm doing this with the monthly payment. I know I'm doing this with this dollar amount. Boom, you're ready to go. Keep making that money. Like I said, you like this video, subscribe to our channel. You get notifications on the new ones that we do. Talk to you guys soon.